Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome each and every one of you to our monthly open house Q&A rapid fire stock analysis, having a fun time for 1 hour session. And what I'm going to do is take care of some housekeeping items first, and then we'll get into it. I have the Market Guys website up right now, and you'll see that at the top here it says reports, videos, and such. I'm going to click on the video tab because I'm going to ask for your help. Our goal at the Market Guys is to provide top-notch financial education. And a while back, a long while, we're talking almost 10 years ago, my partner and I, my partner Bill Shanley, who's recording this right now, we came up with a brand of videos called Market Shots. These are very short videos to give you some information that'll help, and don't let the shortness of the video fool you. There's a lot of content jammed into each one of these mini videos, and it is a library that we're categorizing into different sections. So you can see up here basic options, technical analysis, and trading strategies. And right now we have the call option, we have the put option, such. What I'm going to do is I'm going to ask each and every one of you, if you like, it's not, of course, man, it's just a suggestion. If you could submit to me what topic you would like me to post, because I cannot assume that I know what content you want to learn about. Not everyone wants to learn options, and not everyone wants to learn trading strategies. Some people just want to know, hey, what's my stock doing this week? You know, and that's what this session is for. But if you could go to the Market Guys and go to the contact button right there, click on contact, and submit your name, email, and a message here of what you would like me to record. And I will give you full credit, excuse me, I'll give you full credit for that topic on the recording, unless you want to remain anonymous. That's totally up to you. And we will be posting those to the video page. And this is exciting because we could really never run out of topics, because the way the markets are going, we have so much change and volatility and such that one of the videos I plan on recording is on cycles and how important cycles are in the market, even seasonal cycles like the Santa Claus rally or year-end rally. And then after that we have the January effect, and then after that we have the tax season. After that we have the summer doldrums. The markets actually trade in cycles, and I thought, you know, a short video explaining how that works could really help put the odds in your favor with regard to making money. So if you're up for it, go ahead, submit that by going to the Contact Us link right there, and I will get very busy very quickly, because we're gearing up for 2016, where Bill and I are producing more videos and getting out to the public. That's number one. Number two, whether you're an Option Oracle subscriber or not, the Market Guys Facebook page is a great place to be, because periodically I will put out information that will talk about currency markets, talk about other types of markets, NASDAQ and such, and it'll help you, again, stay in touch with what's moving the markets. And again, for those who do subscribe to the trade alerts, you can program your Facebook page to send you a text message that I just put out an alert that, oh, look in your mailbox. You know, so it's, again, a way to stay right on top of the market, especially when I'm putting out a midday trade alert. You know, I don't always put them out at the close of the market or even midweek. Sometimes a stock will pop up like Twitter did last week, and I have to put it out while the markets are open, and we want, of course, people to be able to react to that as quickly as possible. Okay, so that's the housekeeping items there. Now let's get right into the market analysis. This is the diamonds. It's the Dow Jones Industrial Average ETF, and these horizontal lines and this diagonal line here is what I drew from last week's weekly market report. And what's really interesting about the Dow is that this week, again, we talked about, I just mentioned cycles there a little while ago. Usually the week of Thanksgiving holiday, which is coming up this Thursday, for the Canadians up there, your Thanksgiving obviously is a different day, but for the American markets, usually, now it's not always, but usually the Dow rallies during the week of Thanksgiving to the tune of about 1%, usually. We have not seen that yet. Again, this is only Monday, so we still have a couple more days before the markets close. And then Friday is Black Friday. And I was talking to Gerald this afternoon, and I was mentioning Black Friday to him and how it's no longer just a holiday news blip, on some of the local television stations. It's now become a major economic indicator. And so we don't know what Friday has in store for us, because I can't tell you what's going through the minds of the shoppers and whether or not they're getting ready to camp out in front of these stores at 3 a.m. to get the $20 discount on whatever item they're buying. To me, that's insanity, but people do it. And what's interesting is I saw a couple of advertisements today saying that Black Friday starts today, Monday, and they're even trying to rush the selling season, and that to me is a leading indicator that Black Friday isn't going to be all that great if they're trying to move it up to Monday. So you just don't know what's going through the minds of people, and this could turn out to be a big disappointment, and if that happens, watch out below. So I'm telling you all this to kind of set you up for what could happen should the markets come out disappointed. This horizontal line right here, right around 172, is a major support level for the Dow. And let me tell you what, keep an eye on that price as I switch to the weekly chart, and I'll show you why this is a major support level. See, there's 172 right there. This formation right here is a complex head and shoulders pattern. A general head and shoulders pattern looks like this, where you have a shoulder, you have a head, then you have another right shoulder that's usually lower than the head, and then you have the neckline, okay? And if the neckline gets broken, that is where we go a lot lower. Now, you see the beginning stages of a shoulder here, maybe a head, maybe another shoulder, but it's more of a zigzag pattern. But the key part of this whole equation is that this shoulder is much lower than the highs here. So we're having successively lower highs. A breakdown in that support level could actually create a 2,000, maybe even a 3,000 point drop in the Dow. And you might think, well, how do you come up with that number, AJ? Well, look, if that is the only support level we see in recent weeks, what's the next major support level? It's going to be around 150, right there, 150. So that right there, now you have to understand, this is 150 for the diamonds, but that's 15,000 for the Dow. So if it goes from 17,700 to 15,000, that's 2,700 points just to that support level. And the other thing that I'm looking at on the weekly chart is that we're seeing lower volumes down here. You see that? Lower volumes on the way up. And again, for the regular attendees who follow these sessions, you know that volume is the best leading indicator because it measures the force behind the move. So if the move or the trend has been up and the volume is down, and we're talking dramatically down from September, October, then it's telling us the buyers are getting really tired, or they just don't want to put their money into the market to try to push it to a new high. You see, at 17,700, the market has to rally about almost 1,000 points to get to a new high. And so the buyers don't feel that convinced that buying at these levels, even the institutions, they don't feel that convinced that putting their money in at this particular top is going to bring them to a higher high. And that's what we're seeing in the volume. Now, let's go back and look at actually, I'll leave it on the weekly charts. Let's look at the spiders. It's ticker symbol SPY. It's the S&P 500 ETF. And you'll see that the same thing has occurred here. And we have lower highs, and we have another major support level down here around 180. So this could be a significant drop for the spiders as well, alongside lower highs on the volume as well. So really got to keep an eye on this market and be very, very defensive, because if I go to the daily chart here, you'll see that there's a series of spinning tops, almost dojis now. These are spinning tops. We had a doji on Thursday. Friday we had a spinning top. Today we had a spinning top. Today's volume, not looking very happy right there. Not at all. We have lower volume. Almost, let me see, that volume is, let me get it. That volume is about 20% less than what it was on Friday. And so this spider market here could also drop down to retest that support level. Now let's look at a more broad-based index. That's the Russell 2000. And you can see that the Russell 2000 is looking a little bit more positive than the other indices that I mentioned, but this particular index does not measure volume on this chart, so it's hard to read that. But you can see that the short-term trend is still intact, but we have resistance up there just below 1200. So it's a composite, or an index of 2,000 stocks. The Dow is 30, the S&P is 500, and so this carries a little bit more weight. So if you start seeing, let's say by tomorrow or Wednesday at the latest, if you start to see long shadows at the top, see, we're starting to see long shadows at these two candles. Long shadows at the top mean what? Who's one of the regular attendees that could tell me what a long shadow on top of the candle means? Anybody would like to take a stab at that? Long shadow on top, spinning top, buyers. Okay, what skills? Yeah, buyers are tired. What that means is the buyers tried real hard to push it up today, but they didn't have enough staying power to keep it higher. So we had the sellers come in and pushed it back down, and that is the telltale sign that the buyers are fighting, but the sellers are beating them. Now, on the opposite here, when you see long shadows on the bottom, the opposite is true. It tells us that the sellers tried to push it down, but didn't have enough oomph to keep it down, and the buyers fought them back and won. So I know people, believe it or not, that just trade on the shadows. Look, I mean, I might do a video just on that, on how to trade the shadow. But look at the long shadows down here. You see, the way you would do this in a strategy is if you see a long hammer pattern, let's say, like that. Hammer pattern is a long shadow that's usually 2 to 2.5 times the length of its body. People will buy on that day, or they'll buy on this day, and they'll put their stop below the last previous low. So they'll put the stop down there. So they won't put the stop on the day of that shadow. They'll go to the left, and find the next lowest shadow to put the stop so that they're out of harm's way and the market doesn't whipsaw them at that particular point. And you can see that if you had bought on either one of these days, you would have had a tremendous move up until the point when the shadows start showing on top, at which point you would get out. So you buy with the long shadows underneath, you sell with the long shadows on top. You see, here's another, it's a fairly long shadow. You buy it, put the stop below that low, trade it up. Here's a long shadow up here, or a bearish engulfing pattern up here. You get out, you move on. Simple. It's not complicated, although it makes me crazy when I go to some trade shows or I'll go to an event of some sort and people show me their computer screens and I'm thinking, wow, where's the price action? You have so many indicators and oscillators and Fibonacci numbers and Elliott wave, Gann wave theory and all that. You have all those lines, you can't even see the price anymore. Folks, these are my charts. What I'm showing you right here is what I actually use to trade. That's all I have on my charts. That's it. And what's interesting is that once in a rare while, I'll throw a moving average, either a 50 or a 200-day moving average on there, just to verify whether or not the overall trend is shifting one way or the other. Now, if we go to the Qs, again, this is a daily chart. Look at this, QQQ. What do we have there? Interesting. Can anyone tell me what that pattern is? The most recent pattern today. Who wants to take a stab at that one? This 2-day pattern is what? What's that called? Okay, good. Actually, Larry, you got it backwards. It's a bearish engulfing pattern, not a bullish. Bullish would be a green candle engulfing a previous red candle. This is a red candle, a red-bodied candle, and the body is engulfing the previous green body. So there is a high probability that the Qs are going to drop. And again, look, almost vertical price move from Monday, Tuesday, Wednesday, Thursday, last Friday, vertical price move on what? Lower volume. See that? So this is pretty bearish. And so remember what I said about the cycle, how usually on Thanksgiving we go up. The candles are not supporting that. They're not supporting that idea that we're going to be going up. So what does that mean? Well, the charts are actually talking to you. And this is where, I tell you, I have so much fun doing this because when you read the charts in their simplest form, they actually tell you what you should be doing. So here, let me give you an example. Lloyd, Robert, you answered the same question that Larry did. Let's say that you're long a NASDAQ stock, which is represented within the power shares. But let's say you bought your stock down here at the low, and you see the price going up, but now you see the volume going down, and now there's a bearish engulfing pattern. What is the chart telling you to do? There's a couple things you could do, but what is the chart telling you? Would you go ahead, try that one out? You really can't go wrong by answering, because if you get it wrong, so what? You'll learn something. But what are the charts telling you? Tighten up the stops. Exactly, Robert. Yeah. Either now there's 3 different things you could do. If let's say you have your stop down below this low, it tells you, now what Robert was saying, tighten your stop, meaning move your stop from below that low to below today's low, because that's the bearish engulfing pattern. That's one thing the chart is suggesting. The other thing is sell half of your position. Sell half of it and trail the stop with the other half. And then, of course, bearish engulfing pattern, if you have a sizable profit, the charts will, suggesting, hey, take your profits and run, because you can't lose money taking profits. We all know that. You can't lose money when you take your profits. You only lose money when you hold on when things are going against you. Or you give back your profits when you don't take action, when the charts are talking to you. The bullish engulfing pattern and the bearish engulfing pattern are 2 of the most reliable signals that you can find on a chart. And by the way, that there is a video on the Market Guy's website that highlights both of those engulfing patterns. Okay, last, VIX. Volatility Index. Oh, got to put the right symbol in there, that's for sure. VIX, V-I-X, Volatility Index. Now, in the weekly market report, I suggested that there would be a possibility of the VIX going a little bit lower. And why was I saying that? Because we had two bearish engulfing patterns, bearish engulfing pattern, bearish engulfing pattern, and last Friday we had a red candle right there when I did the report. But look what's happening. We have what's called a half signal. Now, here's what a half signal is. A half signal is like half of a pivot point. The market has been going down, going down, going down, and for the most part, we were showing lower highs and lower lows. Look, from this day to this day, a lower high, lower low, bearish engulfing pattern. From the bearish engulfing pattern to the next day, lower high, lower low. The very next day, lower high, slightly lower low. Next day, lower high, lower low. Next day, lower high, lower low. Today, we don't have a lower high. We have a lower low, but we have a higher high. See? So that's called a half signal. Half signals generally represent the beginning of a pivot point. So what this tells me in the VIX is that we could actually come lower in the general markets, particularly the S&P. So I'm not going to go with the cycle and lean towards the cycle. I'm going towards the charts and what the charts are telling me. Now, please remember, whenever I'm analyzing the charts, it does not matter what the ticker symbol is. You read the charts the same way, whether it's the VIX or a dollar index or a commodity or your favorite stock. You read it the same exact way. The prices do not discriminate and change because of a company's product or service. It doesn't. Investors are investors. They all react the same way. So a half signal is a very significant signal, and you see that over and over again. See, back here, you had lower high, lower low, lower high, lower low, higher high, higher low, higher high, higher low, then it pivoted back down, and then look what happened. You had a half signal. You had half signals in here. Higher high, and then you had, boom, the reverse in the trend. So keep your eye on those charts. The VIX is a leading indicator. It's not a lagging indicator. And volume is a leading indicator, not a lagging indicator. Okay. Now, question came up. Okay, so Michael and Philip. Okay, so Philip had a question. NYSE and NASDAQ will both eliminate stop orders in February. I did not hear that one at all. Philip, if you have a link, please send that to me. I have not heard that. That's almost outrageous because then that means your only alternative to protecting yourself is going to be the option markets. And by the way, even if the NYSE and NASDAQ eliminated stop orders in February, most trading platforms have alerts that are contingent. So I wouldn't worry too much about that because the software will eventually make up for whatever NASDAQ or NYSE regulates. I think what they're trying to do is keep people from running the known stop areas, but you can't not protect yourself in the market. In other words, a contingent order is, let's say, let's go back to actually I'll pick a stock. Let's say Microsoft, okay? And let's say you're in Microsoft, you bought it way down here at 40, it's trading 54, and you think that the stock could go lower, and you want to put a stop below 52. What you would do with your broker is you put an alert to notify you when the stock is trading 52 below support, and at that time the alert goes off, the system, the software, will enter a market sell order in. And let me tell you something. If the brokers don't allow you to do that, there's major, major class action suits that will be launched against brokers to put them out of business if they don't allow you to protect yourself. It's impossible for them to allow you to take all that risk with no protection. And I've seen websites even shut down. I've seen them shut down because in Market Storm back in 2000, literally the brokers would shut down because there was so much order flow coming in. So that's something I would not want to see repeated, but it can happen. Okay, here we go. We have Michael is talking about think or swim. We'll still do conditional orders. That's right. And PB says GLD, time to buy. Okay, here we go. Start putting your stock symbols in. Let me just say, PB, before we analyze the stock, I want to tell you, I'm a major buyer of gold and silver. I still am. And the main reason, and I know this is going to sound pretty heavy, but I'm a military veteran. I see what's going on around the world. And there is a lot of concern about national security, not just within the U.S., but in France. We're seeing that's going on. And now there's threats in New York. Whether they're idle threats or not, the markets are very, very uneasy. And let's look at the diamonds first on a monthly chart. Okay, you have to look at this and weigh this into the equation. Look at this. This is a major trend from 2009 till now. A major upward trend. We have so much room to the downside, it's ridiculous. And it's not going to take but a small spark of news to trigger the Dow lower. It could just, notice what's happening with the Fed. When has anyone who's been in the markets for any length of time, has anyone ever seen such a fickle Fed? Have you ever seen such an indecisive group of bankers and Federal Reserve chairmen and women? Have you ever seen such uncertainty? I've never seen it in over 3 decades. And here's what I believe. I believe that the Fed knows that any kind of interest rate hike is going to exacerbate the cost of carrying our debt, not just in the U.S. but globally. It could literally crush the economies when all of a sudden the trillions of dollars of debt are increasing by the billions per day. That's what could literally happen. So I think the Fed is being very timid now, and that's why I say it's like on a hair trigger right now. So any kind of interest rates or bad news or any kind of a terrorist attack somewhere is going to cause a major fall. Now let's go back to gold. Gold has always been a safe haven. Now this is a 20-year mark chart for gold. It's already come off quite a bit from the highs. But look where we are. I have to go to a drawing here. Does anyone know what this line is? Boom. Right at that high. Can anyone tell me what this line is right here? I'm going to erase this one. Let's see. Who wants to answer that question? What does this line represent? Who's been watching the Market Guide videos? Okay. Let's see. It's a support. Lloyd, you got it right. It is a role reversal support. We are on a major role reversal. The next major role reversal support is going to be down here. And I certainly don't think gold is going to drop below $700 an ounce. I don't believe it. Not with the way the world is right now. So this whole area right here on the monthly chart, going back 20 years, on the monthly chart, this is a major support line for gold. Now let's zoom into the daily chart so we can tell PB some of the other signals that we see. All right. Can anyone guess what my all-time favorite strategy is for trading? Can anyone guess? Who wants to guess? I know there's a little bit of a time lag in there for answers. Okay, Sophie, you got it right. Gaps. Robert, you're right. William, you're right. Gerald, you're right. Nathan, yeah, you're right. Look at how many gaps there are in the gold market. 1, right there. 2, right there. 3 right there. There's another gap unfilled up there. There's another gap unfilled up there. There's another gap unfilled up there. Again, now, in my 33 years, I've never, ever seen that many unfilled gaps above the market in any stock, index, currency, commodity. Never. I've never seen that. Here's what my beliefs are, and you might think this is conspiracy theory stuff, but Sachs is the #1 manipulator of markets. Okay, now let me tell you how I know this. Gary Cohen, who is the second in charge of Goldman Sachs, Gary and I stood side by side in the gold pits trading. Sometimes we trade with each other, sometimes we trade against each other in opposite positions. Gary Cohen and I would trade all day long, gold and silver. I know the guy is manipulating the gold market. I know it. I know him. I know what Goldman Sachs does. Here's what they're doing. They're leaning on it. This is a term. This is a technical term and also an industry term. When a broker or a market maker or an institution leans on a stock, they continue to put pressure in an effort to get it lower to do what? To buy it. That's what they're looking to do. They're looking to lean on it to get that price so low. And let me tell you something. When you see the volume start to soar out of this world down here, when you start seeing these volumes, that means the institutions are coming in. It's not going to be the average investor moving big volume. So I am accumulating gold. I'm accumulating silver in the physical form as well. I go to providentmetals.com. I mean, there's tons of brokers online. I physically put orders in, and I get it delivered to where I am. That's what I do, and I store it because the physical commodity. Here's why I'm buying physical, because if you buy SLV or GLD, they may not even have enough gold to meet the contract demands. Yes, I still think you'll make money, but what happens is all of a sudden they can't deliver you the gold. Now there's a major short squeeze. I'm not going to get into the minute details of the mechanics of the market, but the gold mines are slowing down right now. Why? Because the cost of gold is so low, and the cost of silver is at production costs. So why are the silver miners in Mexico slowing down? Because it costs them more money to pull it out of the ground than it does for them to go into the physical market and buy it. So I love gold and silver at these levels. I don't care what Warren Buffett says or George Soros says. I really don't. I see quite clearly, I see manipulation all the way. Now, here's the other thing. With that said, PB, let me go to silver because SLV is also on a major support level right here. It's below $14. So the way I look at silver, and if you don't want to spend on GLD, you can buy IAU. It's a lesser version of GLD. But the way I look at it is, gold and silver go up and down. It's a major currency. It's not just a commodity. It's a currency. It's also an industrial metal. So eventually it has to go up. Why do I say it has to? Because it's being consumed in computers, in catalytic converters, platinum as well. You have an industrial metal that's also doubling as a currency and a safe haven when all hell breaks loose economically. So I look at this as a long-term investment that I sometimes trade in between, but eventually it has to go up because silver, the metal itself, cannot go bankrupt. It's silver, the metal now, is not being managed by a CEO. The mining companies are, but the metal itself is not a stock. It is something that will always be in demand. It has been for thousands of years. I don't see any reason why people would change there. Now, I know that was a long answer to PB's question, but I thought it was very, very important that we go over that. Okay, now let's look. Ron is looking for an entry point in GLD, Ron, or let's see, there's another one there. Are you looking for an entry point in GLD? Ron, put that back in because I don't know where it went. In the meantime, I'm going to look at Ann's request to to look at UNH. Ron and I will get to you, don't worry. UNH, let me get the symbol in there. There we go. United Health Group. Now, I don't know if it was last month, but this is what I had forecasted way back here, and it did bounce off of that support level. Let me get rid of this. Now, Ann, what I want to do, let me get my drawings out of here first. Hold on. What I'd like to do for Ann is give her a chance to tell me what the charts are showing. Okay, we have a support level that's established. We have a resistance level that's established. This is a trading channel. Now, and fortunately, the stock is still above the support level. The bad thing is, over the past 3 days, while the stock was trying to go higher, the volume has been dropping dramatically. This is what I think could happen with UNH. Boom. The long shadows above the candles are telling me the buyers are trying. They're trying really hard to get it higher, but they're not succeeding. 3 days in a row where we had long shadows above the candle. Remember what we talked about that? Remember? Long shadow above, stock went down. Long shadow above, stock went down. Long shadow down. See that? Over and over again. You look at the long shadows on top, even back here, going back to, when is that? March. Long shadow dropped. So here's even a long shadow. See that? Long shadow dropped. The long shadow on a support level with volume dropping, and I would not be looking to get in it. And if you are already in it, I would probably sell half, and I would protect the rest with a stop right below that low. So I'll keep that in place, and we'll see what that looks like. Looks like next time. Ron, I'm still trying to read your symbol. Is that AJ? I'm looking for an entry point. Oh, or is that ALJ? Is that the ticker symbol ALJ? Let's see, ALJ. See if that comes up. Ron, is this it? Hopefully this is it for you. I hope that I got the symbol right for you. Okay, so again, the charts are telling us something, Ron. Look, boom. What's that telling you? Lower highs. Here we got a converging. This is a wedge, more or less, and a pennant, or even a flag. But what's happening here is that it's reaching the top resistance line, and it's on lower volume. I would not be buying that one. Not be buying that one at all. The only time I would be buying that, Ron, and I'll have to zoom in to show you, is if, ready? If it breaks out, this is not necessarily a good enough breach, because you want to see a breakout of this line or even this high. You want to see a breakout on much higher volume. So if you are looking to get into this, you want the volume to go up on the way up, not down the way it is. So right now, I would wave the caution flag on that, and I wouldn't get into that one at all, at least now. Because think about what I said at the very beginning. Why did I go over the general markets first? Because it doesn't matter if all the general markets, if the major indices are all pointing lower, then why try to find anything to buy at that point, unless it's inversely related to the Dow or some of these indices? Then I would get into it. Like DOG, that's the dogs of the Dow. That's inversely related to the Dow. But if you're looking to buy something when the general markets are pointing lower, you're putting the odds against you. So again, it's a very treacherous time to be looking for any kind of buy signal. So it's hard for me to even find a recommendation in there for you. So so I'll leave it at that. Okay, let's see. CMG. Let's see. CMG. David is looking for CMG. Okay, CMG. And let's see. What does that look like? CMG. David, what are you looking to do with this one? You're looking to buy it, or yeah, if you could, if you put in a stock symbol, tell me what your intentions are, because it'll help me help you better. Yeah, I see a major gap, two gaps here above the market, but the stock just got finished breaking down below a major support level. So I have to go to a weekly chart to find my next support level. And it's not looking very good. The next support level down here around 500. Now, this is a weekly chart. Notice. So let's analyze this. Today, this green candle is only Monday. And look at the volume already. Look at that. We have a lower high, lower low on higher volume. Don't worry about the color of that candle. That's still a lower low. And the week is not over with yet. So there's a good chance this volume could very well be a higher volume. And what does that mean? If the volume is increasing on the way down, it means that the sellers are still motivated. That's what that means. So David, don't buy it until you see a bounce of support on lower volume, or some kind of a significant pivot candle, whether it be an engulfing pattern or a hammer or something. See, by the end of the week, I mean, it's going to be a far stretch, but if at the end of the week it turns out to be a bullish engulfing pattern, yeah, by all means, buy it on Black Friday if it's a bullish engulfing pattern with higher. But if you're trading this stock as a stock, be careful, because it's an expensive stock and the institutions can really push this one around. I would suggest you look at the option markets and go that route with CMG. Okay, Netflix. Sean is asking for Netflix. He's short at the current level. Let's see, NFLX. See if we could help out Sean. He's short it. Okay, now, Sean, I would go along with your short idea at this point, but here's the big but. When did you get shorted? Because I'm seeing nothing but green candles lately, and I'm trying to get rid of some of these signals here. All right, so I don't know when you got shorted, but you had a bullish engulfing pattern last week, and it's seen green candles ever since. Now, if you got shorted today, I could probably go along with that, only because you have a spinning top at a resistance area. So I could support a current short position right now as long as you have a stop above 130. And that stop is going to be at the new high. It would be a higher high than this. The stock is going up. The volume is going down. You have a long stretch of green candles, which is called the stale green light. So I would support that as a short position. Now, remember when I told everyone to keep your pens and paper ready, because we generally find some good candidates. For the option traders, this would be a great credit call spread candidate, thanks to Sean bringing this to our attention. And here's why. If you look at a weekly chart, you'll see that there's a double top look like it's forming here. And that's showing a lower high, and the overall volume for Netflix on the weekly scale is dropping. The highs are showing lower highs on volume. So I would support an out-of-the-money credit call spread, or if you want to take a little bit more risk, I would support a long-term put position that's in the money. Now, for those of you who are equity traders, you had no idea what I just said right there, but we would support that short position and with a more conservative strategy. Okay, Bill Elliott, precision drilling, PD. Let's take a look at that. PD. And Bill, I hope you had a good golf game today. PD, Bill's out there in California, and he's an avid golfer, and we were talking about that the other day. Let's see, PD, why isn't this coming up? It's Phelps Dodge. Bill, I don't, you have another symbol for that one? I don't know, it's not coming up. Boom. Buy PD. I don't see PD coming up. I don't think it's my chart. Did Phelps Dodge change? Did they change this? So, Bill, I'm sorry, I'm not able to help you with that. If you have another stock. Oh, okay, it's on the Toronto. Bill, this platform does not support the Canadian stocks, I'm sorry to say. So if you have another U.S. stock, I'd be more than happy to look at that. Okay. Sophie has a question. When is it a good time to buy inverse indices like DOG, QID, SDS, RWM? Well, Sophie, I think pretty much now is a good time. But I'm not going with the leveraged. I'm not going with the leveraged ETFs because there's just so much volatility right now that you have to be really careful. SDS is it's a ProShares Trust, but you have to look at the weekly chart. We just got finished with the bearish engulfing panel last week, so SDS has to prove itself higher. DOG has also been depressed, but fortunately, it's a cheaper way to take a short position. It's only $22, and that too had a bearish engulfing pattern on the weekly chart. So you have to wait for this support level to pivot higher. So I think now is a good time to look at them, but it's not necessarily a good time to get in until we see prices start to go up in this direction like that. And don't be afraid to look at the weekly charts. Yeah, this is not a bad idea because the weekly charts actually trump the daily charts, because they're much more significant in the weight that they carry in reversing or showing a trend reverse. Okay, all right. Let's see, Bill. If you have another stock, Bill Elliott, if you have another stock, go ahead, put it in there. No problem. All right, Ken Gilead, GILD. If you could tell me what your position is on that, that would be great. On the weekly chart, you're showing a triangle pattern. I talk about this in the market shots. This is one where it could go either way, and here's what I mean by that. Look in the past. Here is a triangle pattern back here. You see that? See how the triangle pattern is? Back here, again, another triangle pattern here. Triangle patterns are great for determining the entry point on the breakout. All right, so you have to wait for the stock to actually break out before you trade it. So Ken, what I would suggest you do is put an alert. You could put two alerts actually. Let me now that I drew my triangles on the weekly chart, let me show you on the daily chart. So whatever that high is, so that high is right around 107.97. Put a price alert for 108.5 on the upside. Then also put another price alert for 102.5 on the downside. Whatever alert fires first is the position you would take. That is actually a strategy that many people trade, the triangle breakout strategy. So if it breaks out to the downside, you'd short it. If it breaks out to the upside, you buy it. Now, follow me here, Ken, because let's say you buy it because it breaks out of 108.5. As soon as you buy it on the breakout, you have to put your stop right below the previous line. Does that make sense? So if you buy it at 108.5, you have to put your stop at like 105.5 down here. On the opposite side, if you're going to short it at 102.5, so you're going to short it with the expectation it's going to drop lower, then you have to put your buy stop above that former support level. So if you short at 102.5, you would have to maybe put a buy stop at 105.5. Okay, that's how you would trade that. But that's a very well pronounced triangle pattern that's probably going to be breaking out pretty soon. So keep an eye on that. Oh, Ken said he's selling the 110 calls. All right, well, you got to be careful with that. Don't sell the calls too early now. I would probably sell the December ones, but I would only sell them if you have a long position to hedge it. Okay? All right, let's see. Watching for a reversal to go short. Okay, there it is. All right, that was for David's position before. Okay, let's see. Michael says PCP. I'm going to put that in there right now, PCP. Holy mackerel, I have to speed things up. Almost an hour is past 3. I got to get going. Okay. Whoa, I would leave it alone. That looks like a buyout there. I don't know what the news is on that. Let me see if I can find news here on that. Michael, if this has any major buyout news or merger or split or anything like that, yeah, it's a buyout vote. Yeah, I see the news there. I wouldn't touch that one because here's what happens. When you see a stock going up because of a buyout, it usually just plateaus forever. I mean, it just goes on in a sideways position. This is a different gap. This is not the average gap that you would expect to fill. Remember, gaps fill about 80% of the time. This is one of the 20%ers that may never fill. So I would leave that one alone, and I wouldn't even touch that one because what happens if all of a sudden the merger or a buyout doesn't take place or something goes screwy with the accounting? I don't know. I've seen it happen. This one could blow up in your face. No problem. Okay, Bruce Weiss, USO. Let's go. Let's look at that one. USO, US Industries Inc., and he's looking to go long with a question mark. Let's see. Remember what I was talking about? Why isn't that going? USO? Maybe I type in USO. Okay, United States Oil. There it is. All right. Now, oil is its own animal. I mean, I could very well support a long oil position, but you have to be careful with this one. Let me erase all these lines right here. Hold on, Bruce. Let me get those out of there. Let me erase all the lines. Hold on. I got a screwed up chart there. Here we go. Erase. I'm going to remove all drawings right there. Okay. Now, I'm going to back up a little bit, Bruce, and I want to look at the weekly chart because I think we might be forming a double bottom. Back here is a very, very strong support level. It's number 1. We have a bullish engulfing pattern that resulted in upward price action, only to be followed by a roll reversal pullback. You see right there, from that low, broke through the low, turned into resistance. So you're in a very well-defined trading channel. That's good. You're on a support level. Remember, this is the weekly chart. If it goes any higher by the end of this week, remember we have a shortened trading day, trading week, this could wind up being a very small but certainly defined bullish engulfing pattern. So that's bullish. Okay, keep that. Now we're basically creating a scorecard for USO, and everyone follow along with this because this could be another trade candidate for us. Now remember, that volume doesn't mean anything because it's only Monday, but look at the volume overall. It's been maintaining. It has not been going, it's just been going sideways. That's okay if it's in a trading channel. So now that we've analyzed it on a weekly chart, oh, by the way, there's a gap above the market here too. That's bullish. So we have a stock on support, bullish. We have volume maintaining, that's bullish. We have a gap on the weekly chart above the market, that's bullish. So far, all the checks are pointing higher, and then we go to the daily chart. Another bullish engulfing pattern, my eye picked that up right away. Hopefully yours can see it too. Today we had a bullish engulfing pattern, very small body red candle, bullish engulfing pattern, with also a gap above the market on the daily chart. Okay? So everything I see here supports a long position. Now, with that said, I'm going to ask Bruce where he's going to put his stop. Okay, Bruce, so you see the chart. Let me back up a little bit. You see where support is. If you buy it tomorrow at, let's say, 13 to 13.30, where are you going to put your stop? All right, we're at 12. All right, that's good. You could put it below even that low. That low happens to be 12.37, so putting your stop below that low would be fine. So if you have $1 risk per share, you simply take that dollar, divide it into 1% value of your account, and it'll tell you how many shares that you get to buy. By the way, folks, if you are not familiar with the 1% rule for managing risk, please go to the Market Guys website, go to videos right there, and go to the 1% rule right there. You click on that, and it will play. That video will absolutely play. I probably should play right now because the sound will come through. But that is the most important video in that whole library, is learning how to manage your risk when things start to go against you. Okay. Ken Wolf, Apple equals a good example of gap filling. Yeah, we were talking about that. People made a lot of money on Apple, and we have a lot of comments that came through email that I'm going to be forwarding to my partner Bill Shanley to post on the website. See, folks, we are looking for good, strong testimonial in an effort to help other people, especially with managing risk. Yeah, it's great when you're making money, but I also want to hear about your stories when you've been able to control risk when something went against you. Okay, we're not going to use your full name. Okay, we had Bruce down here. Bruce, you're on the call right now, but we had a great testimonial thanks to Bruce. We will not use your last name, I promise. But if you have any testimonials, send them to me. Your testimonial will be helping a lot of other people. Because let me tell you why. There's unquote so-called experts, and I am trying to defend the general public from those who say they are experts when they're really not. If you are talking to someone and they say, okay, well, we're going to take AJ's idea, the 1% rule, we're going to turn it into the 2% rule, run from them. There is no such thing as a 2% rule. If you take a 1% and turn it into a 2% liability, all you're doing is giving yourself more room to lose money. Don't do it. Stick to 1% and stick to the charts and stick to what you know best, and don't go with your opinion. Go with the evidence. Just like what we were doing with oil, you know, we were weighing the evidence. We had basically a check mark against everything that we've seen positive, and then after Bruce made his decision to get in, then we put the stop right below the support there, and then you go, and then you leave it alone. Okay, Stan. Okay, Stan has recently. I'm going to leave this one for last. Stan, we can squeeze this one in. On December 6th, I'm going to be going to Disney, so with the family. So we're going to. If you're going to take Disney, if you're going to take a long position Disney stock, I'll make sure I bring a lot of people to Disney with me to support your position. How about that? Okay, bought Disney recently at 115, wanted to hold for long term due to Star Wars. Think of selling cover call July 130. Okay, all right. Here's what happens. Boom. There's a gap right there. The gap looks like it's very, very close to filling. Stan, be very, very careful. Why? Because look what happens. When gaps fill, like it did here, see this big gap? Once they fill, there's a very strong probability that it will reverse. Here's another gap. It filled. What happened after it filled? It reversed. There's a good chance that and you're only pennies away here, there's a good chance that once that gap fills, that's what's going to happen to Disney. If you're okay with losing $17 on that investment, then hold the position. I know you want to hold it for the long haul, but Stan, you have to understand this is no longer a buy and hold market. This is a buy and protect market. And if Disney falls flat and does not get over that high, you have now set a lower low, or at least a double top up here. So be very, very careful with that one. I know Disney's hard to. I used to buy Disney and then call the broker just to get the stock certificates so we can hang them on the wall. Seriously, but I don't know if they do that anymore. But everyone loves Disney. It's hard not to fall in love with that company. But don't fall in love with your positions. I wrote about that. I think it was in chapter 3 of my book. When you marry your positions, it becomes harder to separate from them when the time comes. Remember that. You have to learn how to manage risk. Folks, I cannot believe that hour flew by so quickly. It's unbelievable, really. I want to thank each and every one of you. Please send me what video you would like me to produce. I promise you I'll get to work. Starting tomorrow, I'll start recording, and we will really have a very robust library designed by you and for you. And with that, I want to thank you for joining us tonight. This is A.J. Monty signing off. Have a great trading week, and happy Thanksgiving to all of you. Good night.
For almost 3 decades, A.J. Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guy's 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for The Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our trade alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have 2 services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out or when a trade goes against you, when should I take my loss. The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.